Fusion Mobile, quality e-learning experience on the go.
You're welcome again to Fusion Mobile e-learning platform. Today in economics we'll be looking at the study session on banks and banking. My name is Jacob Uchenna and you are here. Now, first of all, when we talk about banking in commerce, banking is one of the aids to trade or tools that ensure or that encourage trading. Now, what does banking involve? Banking involves granting of deposit, accepting of deposit, granting of loans, safeguarding documents, giving of expert advice to customers. Customers can be made up of investors, it could be made up of depositors, it could be made up of traders and businessmen. So these are the things that are involved in banking. Banking definitely developed as a result of banking activity developed just as acceptance of deposits, and such cases that developed in Great Britain during the Goldsmith era. Now, where bullion is deposited with the goldsmiths, people are issued receipts, and those receipts are actually now used for knowing how much value in gold or bullion that is kept with the goldsmiths. So eventually, those people started keeping their item value in gold equivalent with the goldsmiths, and this translated, of course, has been modernized into certain levels of banking. Now, banking has actually grown beyond that. Banking is no longer just accepting deposits. It also involves giving out money in the form of loans and overdrafts and doing some other things. So now, what is a bank? A bank is just a financial institution that undertakes banking activity, primarily safeguarding of valuables, accepting deposits, granting loans, and so on and so forth to the customers. Now, the idea of banking is the primary point in what we call financial intermediation. In financial intermediation is defined as the process by which finance or money or liquidity is transferred from the financially surplus part of an economy into the financially deposit part of an economy. That is why we have banks. Now, banks will now go with central bank, which is the highest or apex bank in a country. We have the commercial banks. We have other specialized banks like merchant bank, mortgage banks, investment banks, and so on, and development banks. And we have other financial institutions such as the stock market, insurance companies, the capital market, and the money market. Now, these are the things we'll be looking at in the study session on banks and banking, and also financial intermediation. Now, before we move on, you will take some questions will be rolling up on your screen. You take a look at it and we'll be back. Now, the first point we'll be looking at is the central bank. The central bank actually of any country is regarded as the apex bank, or the bank that controls or the economic activities or other banks within the economy. That means that every other bank in the country is headed or is under the control of the central bank. Now, the central bank in Nigeria was established in 1960 after an act of parliament of 1956. Now, the CBN was established to gain financial independence of Nigeria from the West African Currency Board, which was established in London. Okay, one of the aims of that is to get rid of to gain financial independence, as well as financial freedom from the colonial masters. So that means to finally be economically independent. Now, the certain characteristics of the CBN is that one, that it is established It is established by an act of parliament. By act of parliament. It's established by an act of parliament. Now, it controls other banks. It is not established as, okay, for profit motives. Now, these are three main characteristics of what you will refer to as the word characteristics of the central bank. Is established by an act of parliament. Of course, it's not established by any board of directors. It's established by the government through what? Through an act of parliament to regulate the overall financial activities in the country, and controls other banks. Controlling other banks means that every other bank and monetary policy goes through the commercial bank before anything. Now the other one is that what? That it is not established for what? Profit motives. That means just like every other public corporation or public enterprise, the CBN or the central bank is not established to make what? Profit, but to make sure that what? The economy is regulated. Now, what are the functions of the central bank? Now, what are the functions? We'll list certain functions of the central bank. We'll list certain functions of the central bank. That is these functions of CBN. CBN in an economy generally, you have number one, issuing of currency. Issuing of currency. 2, banker to the government. 3, it is what? The banker's bank, as it would be called. Bank. 4, formulation and implementation of monetary policies. 5, lender of last resort. 6, regulation of economic activities. 7, exchange rate management of the world. And so on, serves as agent of the federal government. Now let's take these 7. And the first one says issuing of currency. Of course, it is only the CBN that is empowered by law statutorily to issue currency notes, and they are the custodian of the nation's currency. Now, when, of course, anytime, that is why Nigerian printing and minting is under the supervision and under the control of the CBN. Then the banker to the government means that what? The CBN or the central bank serves as the banker to the government, both the federal and the state governments. Now that we look at that, is banker to the central government we have there. So then that is, they manage the government accounts and allocation and everything. Then banker's bank, it functions as a banker's bank, meaning that the central bank is the banker. That means all other banks in the country maintains accounts with the central bank. Then The other one, formulation and implementation of monetary policies. In such case, what we are talking about is that the CBN is in charge of the formulation and implementation of economic policies that help in determining or achieving economic goals within a country in a year. So we talk about the lender of last resort. This means that the other banks in the country run to the central bank anytime there is a need for extra cash. Since each bank has, each commercial bank or any other bank has an account with the CBN, where they run short of funds, they make withdrawals or get assistance from the CBN. The regulation of economic activities, for instance, exchange rates, of course, one of them is that they could actually design policies that will actually tailor the economy and drive it towards achieving a particular objective, macroeconomic objective. This makes up the functions of the central bank. Now, question is, since the other banks are now under the central bank, that means the CBN controls the activities of other banks. Now, we see the commercial banks are in contact with the what? With the populace, that is with the general community or the other part of the economy, while the CBN is in contact with the central bank. So the commercial banks, once the commercial banks are controlled, the economy is controlled. So which means now, how does the CBN control the commercial banks? Number one, in fact, if you can go back to our study on monetary policy instruments, those monetary policy instruments are the instruments for which the CBN controls commercial banks. We'll recap. We have the open market operation. We have the bank rates, moral suasion, special directive, liquidity or cash ratio, special deposits, and have what we call selective. So now, that's selective credit control. The open market operation is a medium, an arrangement by which the government or the CBN issues government bonds or treasury bills for sale or buys from the world, buys from the public. Now, it issues these bonds and treasury bills for sale when there is need to reduce liquidity in the economy, to reduce money supply, to regulate the consumption pattern or money supply in the economy. It sells so that people will buy into it, and it withdraws money from circulation. And the reverse is the case, where there is need to put in money into the economy. What happens is that it pays or redeems these instruments, these credit instruments, and with the attending interest rates. When we talk about treasury bills are regarded as the instruments used in the money market for short-term government securities. Now, these government securities are mature in a minimum of 90 days, which is 3 months to 1 year, as the case may be. That is why they are short-term government securities. But the bonds are long-term in nature. They are also government securities, but are long-term in nature. We go to the second one, which we call the bank rate. The bank rate is also referred to as the interest rate or rediscounting rate. The rediscounting rate refers to the rate at which banks are willing to grant loans or rediscount what bills of exchange on behalf of a customer by granting them loan. You know, when we discount bills of exchange, it means we are paying it, the bank is paying a debt on behalf of a customer. That means by taking the credit off him, but giving him the money, then when he pays and he's paying back to the bank, he pays with interest. So the rediscounting rate is referred to as the bank rate. The higher the bank rate, the higher the lesser the amount of money in circulation, because the lesser the loans that will be borrowed out. But the lower the bank rate, the interest rate, the higher the amount in circulation. The next one, we talk about moral suasion, which is a gathering of an assemblage of the heads of commercial banks by the CBN in a forum that they are persuaded or urged to adopt a particular banking policy or a particular economic policy to implement it. Then special directive is an order by the CBN to the commercial banks to adopt a particular thing. For instance, the case of the recapitalization policy of the CBN in 2006-2010, as the case may be. And the other one, we have the liquidity or cash ratio. The cash ratio or liquidity ratio refers to the case, the ratio of the part of a bank's total deposit that it is allowed to keep for its day-to-day transactions. Where the liquidity ratio is low, then the money in circulation, the ability of the commercial banks will be low. But on the other hand, where cash ratio is high, then there will be much more money for granting loans, for doing other activities. The next one we talk about is the special deposits. Special deposits is making sure that certain deposits are maintained. Okay, like begging your pardon. The last one, the bank recapitalization policies are examples of special deposits, where banks in 2006, of course, and some other times were expected to have a particular minimum. In the case of 26 was 25 billion in the account for operation. Then selective credit control is a directive to finance a certain aspect of the economy, not favor some other aspects. Now, these are the functions, the nature, and the characteristics of the central bank. Now, commercial banks are actually the link between the CBN or the government and the people as money is concerned. And it is in the commercial banks that the basic banking functions are performed. So, in other words, a commercial bank is a firm that is formed to carry out as a limited liability company to carry out banking functions. The banking functions we are talking about here is accepting deposits, safeguarding documents, granting deposits, and so on and so forth, that we'll see in the course of this lecture. Now, no matter what you do, in banking, a commercial bank is run or has the legal structure of a normal limited liability company when it is registered, or a partnership when it is formed under a partnership. If we recall that a partnership, we said that 2 to 10 people are allowed to establish a partnership banking business, while 2 to 20 establishes every other one. Now, limited liability companies that are established in the form of banks are commercial banks. These commercial banks are, they are established by individuals, they are managed by boards of directors, they are owned by shareholders. They are established for making profits. Now, what are the things involved here? So under this, we'll be looking at what? Functions of the commercial banks. Functions of commercial banks. Now, what are these functions we are talking about? I think we've mentioned quite a few of them. Number one, we have what? Acceptance of deposits. Acceptance of deposits. Safeguarding. Of valuables. Granting of loans. Discounting bills of exchange. Financing of trading activities. Agency services. Advising customers. As in displaying advisory roles. Now, the first one, acceptance of deposits. That is the major function of the central of a commercial bank, accepting of deposits. You know, now the commercial banks actually perform different banking activities, not just basically the commercial banking functions. We need to be current. Now, formally, earlier on, we had specialized banks. We have the commercial bank. We had development banks. We had mortgage banks, merchant banks, and agricultural development banks. Now, these banks are actually now incorporated into the banking functions of commercial banks in the current day banking system. That is where you have the universal banking system, where you have investment banking, you have consumer banking, you have so many of them. We talk about the functions of central bank. The functions of central bank, the first of them is the acceptance of deposits. Looking at the current banking functions, formerly banking was specialized. Commercial banks did not there were specialized banks that performed certain functions, but nowadays we have the universal banking concept, which now incorporates all other functions, specialized functions of banks into the commercial, or the umbrella of the commercial banks. But nevertheless, no matter the kind of thing you want to do, the savings account, you must have an account with the central bank. Here we have what? Savings account, current account, fixed deposit, or what we call the time deposit account, and we have the hybrid account. Now, when we talk about the savings account, is an account that is kept for low income earners to encourage savings among individuals. Now, such cases, the savings deposits is what we call the deposits keep in the savings account, and the savings account is operated using what we call a savings withdrawal passbook. Now, the passbook is what you use to operate or take money from your savings account formally. But nowadays, of course, we have the advent of the ATMs, that is automatic tellering machines. With the cards, of course, definitely with the internet banking facilities, you can always slot a card in somewhere and pick up your cash. So passbooks are fastly outliving excuse me. Passbooks are fastly outliving their usefulness. Now, The current account, which is the second one, talks about it is mostly a kind of business account, but it is an account that encourages what? Encourages large volumes of transactions. And secondly, it is an account in which the operator is charged interest in the form of what we call COT. COT means commission on turnover. Commission on turnover. It is charged at a fixed rate of, according to the rate of transactions that is taken, that is done on this account. The current account is run using what we call a check. So the check leaves, or the check is a written order. A check is a written order by a person, that is account holder, on a bank to pay a certain stated sum to the owner or a specified account. Now, in a case where this deposit, why we call it what? A demand deposit. That means amounts we keep in the current account are referred to as demand. Amounts we keep in the current account are referred to as demand deposits. Now, how does this thing work? We have the checks. Now a check, like we said, is a written order drawn by a customer on a bank to pay a certain stated sum into a prescribed account or to a particular named person. Now the person drawing the account, the customer, is called the drawer of the check. That brings us to parties to a check. The person drawing the account becomes the drawer of the check, while the person to whom, that is the institution to whom the check is drawn, that means the bank on whom the check is drawn, is what we call the drawee, while the person or the account receiving the amount stated on the check, that means to be paid, is referred to as the payee. So we have three parties to a check, which is the drawer, the drawee, and the payee. Parties to a check to run a current account. But it is not in all cases that checks are received or honored. Okay, there could be reasons for dishonoring a check. So we have certain types of checks. We also have reasons for dishonoring a check. Now, first of all, let's take the types of checks. The types of checks, we have the bearer's check, or what we call the open check. We have what we call the crossed check. We have the post-dated check. We have a stale check. Now, we also have the bounced check. Anyway, that one is just, but the basic ones we have the open check and the crossed check. Now, an open check is also called a bearer's check, which is a check that is payable to a person over the counter. The amount is payable to a person in cash over the counter. It can be redeemed or drawn over the counter and transformed into cash. So which means for an open check, there are no lines. Let's say you just have the signature, the name, the amount, signature, account, every other thing is there, and so on. But for a crossed check, we have double lines that goes this way. Now, a crossed check is a form of check that is not payable in cash to over the counter, except when opened by the account holder. That means that a cross check originally is payable into another person's current account, not in cash. It means that when a cross check is issued, it means it has to be issued into another current account, another person's account, and not redeemable in cash. Where the situation arises that the drawer of the check wants it to be cashed, he has to open by signing across the crossed lines. Now, these are these parallel lines. These are the two main types of checks. Now, when we talk about a post-dated check is a check that is drawn or presented to the bank with a date other than the date that it is being presented. That means that if you draw a check for, say, the 20th of June, whereas you wrote the check on the 3rd and put a future date on it, that is what we call a post-dated check. But a stale check is a check that has been drawn for more than 6 months without payment. That means if you issued a check in January, the check is valid until July. But anything after June or July, it becomes a stale check. Now, a dishonored check is a check which the bank refuses to pay, of course, due to some certain reasons. Some reasons come up for dishonoring a check or bouncing a check. A dishonored check could also be called a bounced check. Now, the dishonored check, a check could be dishonored either, one, for inconsistency of signature, inconsistency of name, where we have dummy checks or forged checks. We could have inconsistency between the amount in words and the amount in figures. We could also have a check could also be dishonored because of insufficient funds in the drawer's account. And these are reasons for dishonoring a check. And a check is used to run a current account. Let's move on to this. A fixed deposit account is also called an investment account. It's an account in which a certain lump sum is kept over a particular period of time on which interest is paid, but the owner can only withdraw the amount after giving a prior notice, minimum of 2 weeks, to the bank for liquidation or withdrawal. Now, that is talking about the fixed deposit account. Deposits kept in the fixed deposit account are called time deposit. Then the hybrid account is an account that features a mixed feature of that combines a mixed feature of the savings and current accounts. That is a modern type of account where you can withdraw so many times, or sometimes you can even is a saving account that you can operate with a check, only that such checks do not go through the clearing house. Now, that is talking about types of accounts and talking about acceptance of deposits. Now, safeguarding of valuables. In banks today, you have what we call the private banking vaults. The private banking vaults, the things you keep there are things like wills, things like building plans and other documents, even jewelries. Those things are kept on private basis. You open a private vault, as well we have private banking. Then the next one we have granting of loans. Loans could be of course, credit could be loans, it could be overdrafts. But loan is actually a fixed amount which the bank grants to the customer at a fixed rate of interest over a period of time, which means that the principal loan has to be paid back with interest over a period of time. Before granting loans, certain things have to be considered by the bank or the manager before a customer or a firm is granted loans. Number one is the credit worthiness. Number two is the turnover on the account. Number three is the collateral security, as the case may be, on the account. That means provision of collateral. Number four, we could talk about the credibility of the referees, of the person, of the customer, and so on. Now, moving down to the next one, discounting bills of exchange. I think we've explained this earlier, that it involves accepting a debt on a bill of exchange by a customer and paying it on behalf. Then financing of trading activities. That means they could serve as people that pay on behalf of someone. Okay, when they pay, they serve as what? Agent. They serve as agents to what? To international trade. They pay on behalf of or they stand on behalf of a customer in an international transaction or trading transaction. Then you talk about what? Agency services, which includes so many things nowadays. Then the last one is advisory roles to customers. They advise investors or advise customers on the appropriate account that will be good for them, the nature of the investment that they should do, and so on. And these are the functions of the commercial banks and the nature of the commercial bank. Now, we say we have some other specialized banks. Specialized banks. We have what we call the what? Investment bank. We have the what? The merchant bank. We have the mortgage bank. Mortgage bank, and we have development banks. Now, these are specialized financial institutions or specialized banks. Now, these first one, when we talk about investment banks are banks which accept huge sums or grant huge sums of loans to customers for investment purposes. Investment could be in stocks, it could be in fixed property, it could be in anything, but provided it is not too long a term. That is when we talk about what? Investment banking. In most cases those days, investment banks are not involved in physical or real estate agency services. It could be investment in a particular business that will definitely yield something, but in a long term. But a merchant banks are banks that actually grant loans for what? To facilitate trading activities, trading in goods and services. Now, such banks they existed. Example was what? The Nile Merchant Banks, which was the Nigerian Acceptance and Loans. The Nile Merchant Bank, we had those days that they facilitated trade of goods and services. Then we have the mortgage bank, which is a type of bank, a financial institution that grants medium and long-term loans for housing or infrastructural developmental purposes, for housing purposes. Then the development banks are banks that grant long-term loans for development, infrastructural and developmental purposes. These are the good examples of specialized financial institutions. And the last on our outline today is what? Other financial institutions, that is non-bank financial institutions. Non-bank financial institutions. Non-bank financial institutions. Actually, we would agree that certain institutions deal in financing, but they do not perform banking activities. Now, for example, we have the insurance companies. We have the what? are the stock exchange market. We have the what? Capital market. We have the traditional. Okay, we have cooperative societies. Then how we call the word? The money market. Actually, the capital and money markets are variants of the financial market. But now let's take this. Insurance companies are companies, they do not trade in physical goods, no, but they trade in money. You deposit money with them, but the money is not meant to yield interest, but it is meant to safeguard certain risks. So you pay premium to an insurance company, while the insurance company undertakes your business risks or even personal risks, as the case may be, because there are different forms of insurance. You have whole life insurance, you have burglary, you have auto, you have fidelity guarantee, and so many of them. So now the stock exchange market is a market for the purchase and sale of what? Of securities. Securities we are talking about here are in the form of shares, bonds, debentures, and so on and so forth. But investment securities. And these securities are sold in the floor of the stock exchange by quoted companies. Where these companies are quoted, it means that they are all what? Public liability companies, public joint stock companies, that their shares that have obtained their certificate of trading and are selling shares. Shares could be ordinary shares or preference shares, like we mentioned in a particular study session the other time. And these things, as you can notice, when shares are invested, they earn, shareholders earn dividends. Now the next one here is the capital market, which is the market for intermediation or mobilization of long-term capital through long-term credit instruments such as bonds and other long-term capital instruments. Then the cooperative societies, specifically here we are talking about the Credit and Thrift Cooperative Society. Usually it existed as what we call the traditional financial institution, but the traditional financial institution is more or less of a cooperative among different people. That's what we call the word esusu, or what we call yes, and now, or the ajo. Now the ajo, they come together, they contribute money, regulated, and they give loans to their members. Now the next one is the money market, which is a market for granting of short-term loans. At this juncture, we've come to the end of our lecture on banks and banking and financial intermediation. Now, if there's any question, you'll be having some questions going on your screen or rolling up on your screen. You will look through them. Where you have a question, go back to the video, and I'm sure your questions will be taken care of.